Today, we're going to start the session with a conversation with Christopher Mirabile, Senior Managing Director at Launchpad Venture Group. Do you go by Chris or Christopher?
I go by Christopher.
All right. Well, Christopher, welcome to the show.
Good morning. Thank you for having me. It's a pleasure to be here.
Tell us a bit about your background as well as Launchpad.
Sure. So my background is I actually was an English major, and I started my career in strategy consulting. And I actually ended up getting a law degree when I was a young person and worked in a very tech-focused corporate firm. And I ended up taking one of my clients public, a big enterprise software company. And I went in-house and became an executive in that company, ultimately as the CFO, and then became a full-time angel when we sold that company to another enterprise software company. So my sort of skill set and background really is in and around technology and software, and I obviously have a pretty good working knowledge of legal and contractual and business related issues.
And Launchpad is it an angel group or is it a formal fund?
Launchpad is a network-based group of about 180 investors with a few affiliated funds, but each of the individuals work on their own. And we put
Okay.
about $10 million to work every year.
Mm-hmm.
We've been around for 20 years. We've backed about 130, maybe 140 companies, had about 70 exits over the years. And our focus is really on science and technology centric companies going to market through B2B go to market approaches. And we work on sort of need to have rather than nice to have types of products. So we don't do things like food or consumer packaged goods or gaming or gambling. We really focus on sort of B2B need to have kinds of things in the science and technology worlds.
And within B2B, it's a big focus area for us. B2B, software as a service, AI, platform as a service, all of that is a big focus area for us. Now, do you do both enterprise and SMB?
We're classic venture investors in terms of our psychology. So, we'll look at a company focusing on medium-sized enterprises if we think the market size is going to be big enough to support venture economics. We're a little bit different from a VC fund in the sense that, and I'm not telling you anything you don't know, but the typical venture capital fund sort of has a surplus of capital and a shortage of human capital, right? And a network of investors is the other way around. So the difference being that we can get interested and make money investing in a company servicing a 150 or $200 million market in a way that VCs wouldn't. But if you're going after a market much smaller than that, it's kind of hard to make the math work if you're going to try to fuel the business on risk equity, because the time and risk adjusted returns just aren't going to be there for a risk equity investor. It's probably not the best kind of fuel to run that sort of engine on.
Great. So you've said a lot of things here that I will double click down on and elaborate. But let me first set the specifics straight. What is the geographical boundary of your investment interest?
Launchpad is based in Boston, Massachusetts, and we really do take a pretty intensive hands-on approach. And so we limit ourselves mostly to the Northeast. Our membership base comes up and down the Eastern Seaboard, but we'll do New England and the New York area and upstate New York. But we tend not to invest that much out of the Northeast.
Okay. Now, let's start with some of the mechanics of how an entrepreneur would work with you. Let's say I want to, send the deal over to you, to your group. How would we work? on that? And how do you show it to the 100 investors in your group, et cetera? Just to, you know.
Sure. Well, like everything, we get a fair amount of deal flow. So, having a warm introduction is helpful. It's not an elitism kind of a thing so much as a human nature pragmatism sort of a thing. And our members are all available on LinkedIn. So if you search for Launchpad Venture Group on LinkedIn, you'll probably find someone in your network, even if you're an entrepreneur, who's at the beginning of her career, you'll probably find some second degree connection. So that's certainly one way to find a little bit of a warm intro. But any entrepreneur can go right to our website, launchpadventuregroup.com. It's a long URL, and just hit the entrepreneur button and just fill out a short summary profile about the company, and that will put you in our queue. And we will reach out, and we actually have a couple different programs. Sumatra, we have a traditional sort of monthly main forum where companies that are, presumptively really ready to work with investors like ourselves, present. But we also have, and that's usually 3 companies a month, and there's 2 out of the 3 of them tend to go right into diligence. But we also have a catalyst program, in which we look at about a dozen additional companies a month, and that's really not intended to be as much of a investment forum as an opportunity to begin a relationship, get to know some investors, get some informal feedback. And we poll the participants and give written feedback to every company to try to be helpful. And typically what happens out of a dozen companies in a month is that, about a third really aren't going to be a fit. And we're very, very honest with them about that. So we think it's a sin to waste entrepreneur time. So if it's really not going to be, go ahead.
Just in the interest of time, Christopher, let's the way we work is that I will send you deals. If you're working with 1Mby1M, I will be sending you the deals, and they're fully vetted to fit or not your. I wouldn't be sending you stuff that you would, reject out of the gate. That due diligence is done on our end. So given that, what is the stage? What is the check size that you guys like to write? What stage do you want to come in? What do you want to see in the validation metrics?
Sure. We're typically participating in sort of the classic 500 to $2.5 million round. And kind of seed. I mean, these terms have become meaningless, but on average, we tend to invest most frequently right at the point of market entry. So there's a minimum viable product, and there might be a couple customers piloting, not necessarily a lot of revenue, but there isn't a lot of technical risk left in the company. We know the product can be built, and it has at least a value prop. And we really tend to be funding that first go-to-market. Testing of that first go-to-market hypothesis in search of trying to get a repeatable sales model. So that's really the stage we do most commonly.
But you want to see some customer engagement, yeah?
If we know the entrepreneur or we know the category exists, we'll invest as early as the PowerPoint stage. But if it's an unknown or a first-time entrepreneur and it's a speculative product category, we probably, we don't need to see a ton of revenue, but we need to get comfortable that this is going to be a top buying priority for the kind of customer that they're targeting.
Yeah, okay, great. Now, you talked about a specific category that we have been paying a lot of attention to long before, it became fashionable to pay any attention to this category, which is that, smaller TAM than what is considered venture scale. The venture scale TAM typically has been, has to be $1 billion or multi-billion-dollar TAM. And that has left that category of 150, 200, $500 million TAM as a, undesirable category. But my observation has been for a long time that, there's a lot of exits, strategic exits in enterprise software in particular, other kinds of as well, that happen in the sub 50 million range. And to make money off a sub $50 million exit, you have to build a company in a very capital efficient way, and so that everybody can make money. But that category of like $150 to $200 million TAM, where it fits strategically into somebody else's portfolio and can go to market through their sales channel, is actually a very attractive category. And for angels or small funds, it's a very, very good category. So
I couldn't agree more with you. I mean, I feel like you're reading my playbook back to me. And I'll give you a great example of that if you want, just one anecdote.
Yes, I was going to ask for examples, exactly.
We had a great, this is, if this isn't a perfect example, I don't know what is. We had a company that was a SaaS company. It wasn't technically recurring revenue, but it was repeating transactional revenue. They had a lot of repeat customers. And they got a thoroughly mediocre revenue multiple. They exited for 4x revenue. And that deal was a 21x cash on cash return for us and a very good IRR. And the reason for that is that they were very capital efficient. We seeded them about 400K, and then we put another $1 million in, and the team got to a $20 million revenue run rate and got acquired for 4x revenue, clean little cash acquisition for $80 million, and it worked out to a 21x return for us.
There you go. So, by the way, if you're interested in us profiling this case study, please send them to us. We'll do that because we have a bootstrapping to exit track and we consider these kinds of very small amounts of capital invested deals as bootstrapping, basically. You have to be able to get to $20 million with 1.4 million in cash in, you have to bootstrap. And that's something that we really believe in and we really support and promote very extensively. So we're very much with you on this line of thinking. And, like you said, whereas these very large funds can only invest very large amounts of money, otherwise their human capital to capital ratio does not work out.
Yep.
In your category,
they just can't manage that many deals. It's very hard for them to play.
Exactly, you cannot manage that many deals. That's right. But you have the ability to do that, and that's very attractive.
Yeah, it's interesting. You read about large exits all the time. You think they grow on trees, but what are there? A handful, a couple dozen billion-dollar startup exits in a year at most, out of something in the ballpark of 400 to 500,000 startups created in the U.S. each year. Statistically speaking, pushing an entrepreneur into a high capital, big exit path is, statistically speaking, dooming her to failure.
That's right.
The average M&A in the United States is well below $50 million.
That's right.
And there are certain companies where you'd be an idiot not to go big on the capital, right? I mean, there's some that are serving a global market of like Snapchat or Instagram or something, and you've got no choice but to use capital as a weapon and go big. But for many, many entrepreneurs, they're better served by staging capital more thoughtfully and not locking themselves in. There's a lot of different harvest points that on the capital curve, and often entrepreneurs are better served by selling and letting a private equity or a venture capital or somebody else take the business off their hands and going back and starting again and doing the fun part that they like the most.
Yeah. I was talking to an entrepreneur yesterday. This is his fourth rodeo. And this time he's already found product market fit and it's scaling and it's going to be a unicorn kind of deal. But his first three ventures were bootstrapping to exit. He got like small amounts of capital. Each time he got like tens of millions in exit. And that's a very successful career, very, very wealthy, career profile. So yes, we are very much in tune, and I would love to. I'm very happy that you came and reinforced this point of view. We've been if you go back and look at my work, I've been promoting this point of view for 15 years now. And it's been pushing a rock up the hill because the TechCrunch style media writes about unicorns, writes about how much funding, and it's like, who raised the most funding is the game that entrepreneurs are playing, and the problem is the naive first-time entrepreneurs are learning a bad, example that, oh, that's what I need to do because everybody else is doing it, and that's what TechCrunch is writing about.
Yep.
So anyway.
Sometimes I feel like a stodgy value-based investor in a momentum-based world. And you sometimes will see venture capitalists say that they never focus on exits. Well, I hope their LPs don't hear them say that because it's nonsense. Of course they do.
You
And
have to
they
exit.
they say that, exiting early is a crime against nature. Well, not if the market size isn't big enough. And
Yeah.
forcing the company to take a bunch of capital, it can never pay off. It's sort of like if all you have is a hammer, every problem looks like a nail, and you just
Yes.
jam capital into every company, and it might work out or it might not, but it's basically reckless disregard for the founder's well-being.
Yeah, and another truism that I hate is this go big or go home. That is such bullshit. It's not even funny.
If the market is a
Anyway,
truly massive market, it might apply, but in many cases, you're a couple pivots away from a really big market.
yeah. So let's talk a little bit about what you're seeing in your deal flow as well as in your portfolio in terms of interesting trends. I always like to ask, because that early stage deal flow is indicative of what's happening in the pipeline of technology, pipeline of, interesting developments. What are you seeing? What's interesting?
Well, obviously, asset prices are stupid right now, and that's difficult because doing the kind of investing you and I do, you have to be disciplined about price and about staging capital. So those are difficult circumstances, and I feel like we're in. There's a lot of hype about crypto and so forth, but we're not paying much attention to that. I'm sure crypto is going to be an important technology down the road, but that's not really a focus for us. I feel a little bit like we're seeing very good opportunity, relatively speaking, in the health and life sciences area right now. It's particularly hot in Boston, and there seems to be in tech, there isn't any particularly well-defined locomotive right this second. The transition from PC to client server, or web services, or internet in the dot-com era, or the mobile. We're in a time right now where it's blocking and tackling. The really, really big companies like Google, Facebook, Apple are just so dominant that it's harder for little startups to really get in and change standards and create new norms. And so there's a lot of little marginal and incremental improvements. We have basic things we have to solve, like cybersecurity. I think 5G will be a little bit of a locomotive once it becomes more widely deployed. But we're not sort of seeing one unifying super hot tech trend right now that's really becoming a train that everybody's jumping on. We're seeing a lot of incremental improvement across a lot of things. We also feel like certain categories like MarTech, digital marketing, a lot of those categories are getting kind of tired.
Mm-hmm.
And you're finding that, to
Tech
the
is very, very crowded.
you find a little product market fit and you make a little bit of a difference, and then the tool loses its effectiveness in 6 months. Consumers are fickle. The next thing is just one click away. And so we're being really very thoughtful before we commit money into sort of the ad tech, martech space. And we're spending more time on problems that are sort of buried deep in industries. So, for example, we're working with a company right now that's very focused on one aspect of operations in the self-storage market. That's a market that's growing steadily, but it's also been invaded by some big REITs and private equity firms, and there's a lot of roll-ups, and there's some real business process problems that need to be solved. And so we're working with a company that's doing that. We do a lot of med device, a lot of diagnostic, healthcare IT, digital health. But we'll look at anything, and it doesn't have to be sexy or consumer oriented or planning to build a $1 billion brand. It has to be solving a problem that people care about.
To your comment about locomotive, I think the theme that we see constantly right now is artificial intelligence and machine learning. Now, that being applied to a lot of small problems, I think, is a perfectly viable way to build businesses. So where there is domain knowledge and where there is, in some esoteric space, is fine, and there you can actually build significant businesses applying that concept into vertical SaaS, basically.
I think you're right to a point. It's a little bit like, it's not an end in and of itself. It's a tool. And there's an enormous amount of hype around what basically boils down to statistics-informed decision making. A lot of what's called ML and AI is nonsense. It's really just looking at a medium-sized data set and making a statistics-informed decision, and that's great. And I think that AI it's a little bit like a website in 1994. You could say, oh, we have the web, and now every business has the web. Or there was a time when people were saying, oh, I'm a digital marketer. It's like, well, not every marketer is natively digital. So I think AI and ML are really headed towards being very ubiquitous. And I think that for most applications where being 90% correct is good enough, it's an incredibly valuable business tool. And I agree with you that it's an accelerant. And it's a way that a challenger can leapfrog incumbents by investing in better, faster, smarter software. In businesses where 90% correct isn't good enough, and you can't rely on the existing tools out there in open source and otherwise, and you're having to build fresh AI with a fresh data set from bare metal. That is not an angel's game. That is a big capital play.
That is true. And we have a big coverage of AI. We have the Thought Leaders in AI series where we cover. We see a lot of great companies come through. Very recently, we haven't even published the story yet. It's coming. I saw a company called Icera, and that was really impressive. They're not only doing AI-driven customer support, they can actually take over the screen share of the client's or the customer's computer and fix whatever needs to be fixed in AI, full automation. That, I think, is really impressive. So and you're right. That is not an angel's game. That requires big capital.
One of the things that I sort of talk about that illustrates your point is that, as a general matter, most startups, their biggest competition is inertia. The existing, good enough, and to break into a market like that, you sort of have to be 10x better, faster, or cheaper. And AI and ML really can be enabling tools to allow you to leapfrog the incumbents. So I agree with you on that, but you have to understand what you're getting into. And an entrepreneur who gets up and she's just hand waving, we have AI, send your checks. You got to dig in a little further than that.
There are a lot of wannabe AI companies out there that are not real AI. They're just buzzword AI companies, and I don't think they're going to get anywhere really. Very good. Well, very nice to meet you, and hopefully we'll have a chance to collaborate in the future.
I'd like nothing more than that. I appreciate you having me, and it was wonderful to get to know you. Thank you for the work you're doing. I think 1M by 1M is truly impactful and helpful, and I'm grateful that you're investing in our shared community. So I appreciate what you do.
Thank you. And by the way, my roots are in the Boston area. I don't know if you're familiar. I lived my first 7 years at MIT and Smith College. So
Excellent. Come back and see us.
we'll do after the pandemic.
It's just like Silicon Valley, except without the hype.
I'm very familiar with the area, and I love it, actually.
Okay. We'll talk to you soon. Happy New Year.
All right. Great.
Bye-bye.
Nice to meet you.